Hello
Cool.
and welcome to the Property Trio. It's my great pleasure to be presenting this morning alongside my co-host Dave. Mike's having a nice little holiday, so it's back to the two original musketeers today, Dave.
Yeah, looking forward to it. Mike will always be missed, but he certainly has a well-deserved holiday, and I
Yeah,
hope
he
hope he
does.
enjoys himself.
Yeah, I think he's off with the kiddies. I hope so.
Yeah,
It'll be fun to
yeah.
hear all
It's
about
been
it.
it's been a for most property-related businesses. It's been a challenging period
Mm.
since the budget. So it's always nice. We're just talking about times like this to get away for a week or two here and there and just get a bit of perspective.
Mm. Yeah, yeah, a bit of chicken little. The sky isn't falling. You just need
Yeah,
to get your head out of your business and get some sunshine and
yeah.
then come back in with a fresh outlook. That's what I've got planned. I'll be recording from Bali next week. Can't wait.
Lucky you.
Yeah, I'm going to take the microphone and everything over in the luggage.
Yep, know
Why
all
not?
about that on our caravanning trip and many
Yeah,
recent visits up to New South Wales to visit
exactly.
visit Dad and Mum.
Yeah. Well, today we're breaking down a good listener question, and we've both actually had a lot of fun with this because we've come at it, I suppose, from our two angles. And you'll be talking about the planning side of things, and I'll be chatting about the strategic, property advice piece and some of the questions people should be asking themselves when they're looking at acquisition. So let's dive into it. We've got a lovely question from Scott. Hello, guys. Thanks for a great podcast. It's definitely the one I look forward to the most. Thanks, Scott. We love hearing that.
Yeah, nice to
I'm
hear. Sounds like
hoping,
he listens to a few of them, and ours is his
yeah,
favourite.
spring in my step today. Thanks, Scott. My wife and I are almost 58. We're living in Queensland on moderate incomes. We're retiring in 2 years when we hit 60, and by then we'll have approximately 800,000 in Australian super. We currently rent and we've done so for the past 18 years. We have 5 investment properties, 4 of which are in Moreton Bay in Queensland and one in the ACT. They're worth collectively $3.2 million dollars with a loan of $1.1 million, and the LVR is just a mere 35%, which is awesome. We pay interest only on the loans, and we make approximately $20,000 in positive cash flow after costs each year. The plan is for us to move into one rental and the kids move into another. Happy days. I will say that as well. I think that's happy days for your kids, Scott. The 3 properties that will remain rented will still generate positive cash flow, so we'll still be making money. My question is, are we mad to be considering buying to purchase, for example, a $500,000 unit in outer Melbourne? Dave, note that they'd be borrowing the whole lot. I note that
Yeah,
we're close to retirement, but we just can't look the other way on these Melbourne unit prices. I grew up in Frankston North in the 80s, and so I'm pretty familiar with Melbourne. We've calculated that in our current position, the super balance will be down to $100,000 in about 6 years. So it's then that we'll start to sell off properties as needed. So, what do you guys think? I feel like we could carry another property cash flow over the medium term until Melbourne property prices return to their former glory. Cheers. Thanks, Scott. There's a lot there, isn't there?
yeah. Look, it's a great situation scenario, one for us to work through, and they're probably in a position that a lot of our younger listeners who are in their 20s, 30s, 40s would like to get to with owning those 5 investment properties as they enter retirement and having positive cash flow to assist in that stage of life.
Mm. Well, let's start with the big picture. This couple already have 5 investment properties worth 3.2 mil, and they're 2 years out from retirement. So before we even get to the Melbourne unit, what's your first reaction to where they currently sit?
Yeah, look, as I just sort of said, these guys have done really well. So well
Mm.
done, Scott. An LVR of 35% on a $3.2 million portfolio, 20K of positive cash flow each year is a really good foundation. They're a great example of people who decided on a strategy of rent vesting, which they've done over, he mentioned, the last 18 or so years, and they've made it happen across the 5 investments. And the fact that Scott is asking, are we mad, regarding this sixth investment, and has taken the time, to fill out this information, email us a question, shows he senses there's something worth examining here. And, has that instinct to pause and review and, develop a plan really with
Yes.
our assistants across a pod. And obviously we can't do that fully. Um, but we can certainly provide a lot of guidance and food for thought for him and our listeners, before they commit, to this next potential purchase. And obviously the elephant in the room, if you like, is the fact, they're so close to retirement.
Yes. Yeah. Look, I think that's an important question to ask. And, if we zoom out, what should they be asking themselves before they consider any listing, let alone a Melbourne listing?
Yeah.
It's
Yeah.
how much is enough? Where are we? What
Yeah.
what retirement do we want? It has to start with numbers, doesn't it?
Exactly. 100%.
Well, on that note, how many properties does someone actually need to retire comfortably? Because on the surface, I'd say 5 investment properties at 3.2 mil sounds pretty good.
Yeah, look, on the surface, it sounds great. But before they commit to this property purchase, I always want to understand what you've just alluded to, Kate. What are they trying to achieve? What does retirement look like for Scott and his wife? Let's get specific. We need to know what income do they want in retirement. So a key part of working that out is deciding what's your lifestyle cost. So you can look at today, strip away, if you plan to carry debt, or if you plan to pay out debt, you've got to work out, is your lifestyle, would you like it to stay at the level it's at? Would you actually like to travel more, and potentially your living expenses might increase? But we know over, if you plan to live, and who knows how long any of us are going to live, but if say they want to factor in living for 30 more years, we know naturally, as we get less able to move and travel as we get older, our living expenses do decline.
Yeah.
So we don't necessarily have to have a passive income that would cover our current living expenses for our entire state phase of retirement. But
Yeah.
these are the sort of conversations you need to have. And once you work through, until you answer those questions, you can't really assess whether this purchase is a good idea or not. So this is the way we approach this with clients. Obviously, when we build out our property plan with our software, define the goal first, and then figure out what's required to get there based on their current financial position, and with what the end financial goal that they are looking for. And then we can, model out different scenarios and tweak, compare and contrast to actually have a plan. And, it helps actually make that decision really clear. Should
Yes.
should we buy this or shouldn't we? But also, you can factor in, okay, let's say we hold it for this long. Let's say we do get capital growth of X amount. But what happens if
If we
the
don't.
market stays flat for, the next 7 years? What is that? And how detrimental might that be if we make that decision right now? So that's when you can make really informed decisions.
That's a really good point, Dave. And I don't want to make an assumption about the thought process for Scott and his wife in this question, because I might get it wrong. But I would love to, if I was sitting down to dinner with Scott, I would love to ask him, did you have a plan to buy a sixth acquisition? Or did Melbourne just, start to sparkle and excite you because of the buying opportunity?
Yeah.
And I'm guilty of that, which is why I'm asking. Ian and I finished our acquisition strategy a long time ago. Well, we finished our acquisition process a long time ago, and we're satisfied with what we've got, and we've modeled the numbers and we're on track. And every now and then, obviously I'm in the business, I might see something really exciting and get dazzled and ask him about it. And he just rolls his eyes at me now, because we're done. It doesn't matter how sparkly or how exciting something is. The only reason why we would buy another property is if we made a strategic decision to offload one and replace it with another one. But, at this stage in our lives, that's not something that I think is likely. So that is my question to Scott. Did you get excited about Melbourne after the event, or have you always had a plan to circle in on Melbourne? And did you have a plan to buy a sixth property at this stage in your acquisition journey?
Yeah, look, that's a great question for Scott and his wife to consider
Well,
as
you
part of this
hinted
process of deciding whether
absolutely.
they
And
buy
you
or not.
asked the devil's advocate question, which is a perfect question, especially given the length of their runway until they retire.
Mm,
Yes, if Melbourne does great, it's been a fantastic move. But if it doesn't do great, if it takes longer to adjust back to its historical performance, or if
mm,
it never does, and
mm,
I'm not meaning to sound doom and gloom, I'm just wanting to
mm.
be realistic with Scott.
Yeah,
We have to look at all of the scenarios, a bit like when we were looking at the impact of COVID and we used to look at, the graph with all of the different scenarios. You have to be prepared for the good, the bad, and the ugly.
yeah,
Um,
and look, that's exactly right. And like with investing, and it's the same you're constantly doing when you're running a business.
mm,
You've got to have one eye on, I think you use the phrase every now and then, the Pollyanna view of what happens
mm,
if everything works out perfectly. But you actually have to have the eye on the other end of the scale too. What if, henny penny, what if the sky falls in?
yeah.
And, you just need to understand both those outliers and then work out, okay, given it could go this way, it could go that way, but where do we feel about the risk and the potential outcomes, and then you can make an informed decision.
Yeah, most definitely. Well, Dave, on that note, I've got a question for you. What if they do go ahead with the Melbourne unit, should they be thinking about it differently to how they might have approached their earlier purchases?
Yeah, look, definitely. Every property decision should be made in the context of your stage of life, your time frame, and goals. So earlier in life, you can afford to lean into capital growth because you've got time on your side to ride out the cycles. But look, these guys at 58 with a plan to start drawing down assets in around 6 years, the maths changes. And this is where the conversation about growth versus yield becomes really important. A growth focused asset generally comes from with a lower rental yield or return, and it can take years, sometimes over a decade, before it becomes cash flow neutral or positive. And that's a tough ask when you're heading into retirement in a couple of years and want your portfolio supporting you rather than meeting the cash flow shortfall.
Mm,
And especially even more so now that you cannot negatively gear on established property. So to get the gearing benefits of the cash flow loss, we know now if it's established, you need to hold the property until it's cash flow positive. And look, at that point in time, you are flying because the rent is actually tax free. And I don't think a lot of people understand that enough. So, until you soak up those historical losses, it's actually your income's tax free.
mm,
Um, look, that's real delayed gratification for those willing to make that great long term property investment decision now. So, but if you're going to do this, I'd be steering the conversation towards a more rental yield focused or at least balanced asset, something that isn't going to be a drag on cash flow at the exact time when they enter retirement and they need their portfolio to be doing the opposite.
yeah.
Um, this is where their instinct to look at an established unit in a lovely period block in a great location is heading in the right direction, assuming that's what he's talking about with regards to the unit.
Yeah.
So just in Melbourne, the average gross yield for a house sits around 3.4% at the moment, whereas units are closer to 5.1%, and both are rising. So look, one thing to note, and I've said this from the start of the budget announcement, I think what we'll lose in annual growth moving forward, we could see replaced by an increase in yield. And that transition is happening before our eyes right now. And I think it's going to play out pretty quickly over the next 6 months to year or two. We're going to see very high yields, and people I think, will pile back into the property market, and then we will see very strong growth at some point. So Treasury modelled those prices may grow at 2% slower, and that rents will rise faster. They said it was really a negligible
They said
amount.
$2 a week, but
$2 a week. I would
I
posit
don't know
that
whether.
rental yields will rise by around 2%,
I
and
agree.
that'll offset the weaker long-term capital growth, meaning the net financial outcome for property investors who have that long-term view and can soak up the losses on established property will remain basically the same.
Yeah, couldn't have said it differently.
Very good. Well, look, even if I think also if these tax laws or some of them get repealed, we're going to see a window between now and either the tax laws being repealed. And look, we can't guarantee that. Obviously, that's going to happen. But even the next time interest rates start to fall, that it's going to be an amazing time to buy. And like always, when we're in a period of a falling market, when you look at it on that graph of what the property market's done over 20, 30, 40, 50 years, it's always a blip. And while you're living through it, it feels like a big deal, and all of a sudden it's over. And the falling period tends historically, not always, and depending on the markets that are more, tend to bounce up and down a lot more. But they tend to be shorter periods of time. So
Yes.
yeah.
Do you know the startling thing? Whenever I look at a chart with property performance over the years, it's government intervention that really jolts things. I mean, we can look at the pandemic, but most of our other really big price hikes and price falls have been based on government intervention.
Yeah, it's a really telling insight, isn't it?
Yeah. Yes. I know we've talked about what a free market would look like, and it's not realistic because we do have a government and a regulator that has to intervene. That's the decision that our nation has made in terms of fiscal policy. But my goodness, we've seen them get it wrong a lot.
Yeah, I mean, look, I understand the concept of free markets, but it's sort of a furphy. I mean, when you have governments intervening,
that's right,
and changing laws, they have an outsized impact.
Yeah, very true.
Cate, with the negative gearing changes making cash flow more challenging for investors, do you think affordable outer ring units and middle ring apartments around the 500 to 600,000 mark could finally have their moment in the sunshine? And are investors going to start prioritising a lower entry price over chasing a house, do you think?
They already have. It's really interesting. Here we are, we're only 2 months in and less than 1 month in since it's actually been legislated. And we've seen a huge shift, a real pivot, because not everyone wants to buy new. And we've talked extensively on this pod about why we don't love the idea of buying new. And I don't want to be negative and slam every single new property, but I'm comfortable to say more than half I would be very fearful about. It takes an anomaly product as a brand newie to outperform and excite me, but they are out there. Yeah. Anyway, I digress. We've seen a lot of investors pivoting to established at the lower price points because they obviously recognise the benefit of established. You're getting a higher land to asset ratio, you're getting less in the block, and your outgoings are generally much lower. Even though they're much older properties, you're not dealing with lifts and concierge and all of the things that can make a high-rise, high-density block a lot more expensive. Now, combine that with the fact that first home buyers have always enjoyed these types of properties because they're usually well located. They're near amenity, they're in pretty streets, street parking is usually abundant, they've got public transport nearby, cafes. There's a lot of reasons why the old, 60s, 70s, even the 20s and 30s boutique apartments are favoured over the newer stuff. So yes, we've definitely seen investors moving towards them, and the investors are doing it to capitalise on what they determine a better long-term growth prospect, but also for an established property, the yields are so much higher, especially in Melbourne. We've seen really rapid gross rental yield movement over the last couple of years. You can now get 5.2% and in some cases 5.5% if it's nice internally as a gross rental yield on a unit. So while that will still be a negative cash flow property, it's not half as big a burden as what investors were targeting 6 months ago when they were buying houses in the low socioeconomic suburbs for 700 and 750. You can hold a unit for a lot less. And so, a lot of
Yeah.
people are pivoting to that. And I know
Yeah.
that we've seen interstate buyers agents doing that big pivot too. And I don't rate all of them, but I've certainly seen the trend.
Mm.
So will they have their moment? Yes, they will. Is it artificially fueled? I would say not. There's a lot of merit in these low density boutique apartments. I've seen them building strength over the last probably 3 years. They've been dogs as performers for the 15 years preceding that, but they have been moving steadily since, probably since after COVID, when we've seen people returning back to the inner suburbs and getting closer to the city. It's
Mm.
interesting though. You've asked me, could they finally have their moment? I think they could. Will it be long lived? It should be a decent recovery, unless, of course, these laws are repealed. Now, if the laws are repealed, we'll just see a swing back to what we've always seen pre-changes, and that will be houses. It doesn't mean that apartments will suffer and do nothing, but I think that they won't go quite as well if we do see our negative gearing changes repealed. Interestingly, for this couple, they're not the cohort I would have thought would be chasing an apartment, but because they already have a positive cash flow portfolio. So realistically, if someone who is a multi-property investor wants to chase another investment that's got negative cash flow, as you said, they won't pay any tax on their rent. So they'll get a different kind of negative gearing benefit. They won't be able to claim their losses against their PAYG income, but they'll be able to pay their loss, claim the losses against the rent that they're receiving. So I would have argued that someone in their position might have gone a little bit harder and got something that's even more cash flow negative that has an even greater chance of capital growth. But having
Mm.
said that, they've only got 2 years to run until they want to retire. So I completely understand it. I think for all of those reasons, though, that's why we probably will see boutique apartments in Melbourne, showing their strength over the next couple of years.
Yeah. Well, we've been talking about them for the length of this
A long
podcast, haven't
time.
we?
Yeah.
And before that, whilst obviously with clients and amongst ourselves, and they were such strong performers, the established unit market in
They were.
Melbourne for decades, and then they basically came to a grinding halt 15 to 20 years
Mm,
ago. So
yes.
you think that market, they're just so affordable with such high yields, and there's so many in such great locations in inner suburbs.
Yeah.
Um, you think they would have their time to shine again.
Yes. And I think if we have a look at Sydney and the performance of quality apartments there, that our cities are very, very different.
Mm.
But it's not an Australia-wide thing. It's a Melbourne thing. And we had an enormous number of new builds and high-rise and high-density apartments
Yeah,
on our in our inboxes and in
mm.
the real estate feeds, and I think it just really watered down
Yeah,
apartments and the demand for them.
yeah. We do have such a high percentage of apartments relative to all properties, and the Victorian government has and is pretty good at building new property.
Mm, yeah, very true. Let's bounce back into the negative gearing piece because this is something that a lot of our listeners are thinking about right now, given the recent changes. And of course, our second last pod recording, we talked about, well, we used the word loophole, and I don't like that because it sounds dodgy,
Mm.
but opportunities to continue getting negative gearing that a lot of people haven't been talking about. So, given the recent changes and negative gearing where it sits, how does that play into this specific scenario, Dave?
Yeah, so look, we've covered how obviously if you buy established property post the 7:30 p.m. on the 12th of May 2026, now you're not able to negatively gear. But we also last episode spoke about that, so we've called it loophole or whatever you want to call it. You can turn an existing home into an investment property post that date and claim negative gearing benefits because it was purchased prior to that date. Obviously, these guys don't own an existing home. So that so that obviously doesn't, the home equation doesn't apply to them. Now you might be thinking, well, they're looking at a yield focused property, so perhaps negative gearing isn't all that relevant here anyway. But they have said they intend to borrow the full purchase price. So the interest bill on a fully borrowed 500K unit will certainly be significant and above, the rental income. And then you've got to factor in the holding costs as well. So it's going to be negatively geared. And so they're going to have to prop up the cash flow position.
Bearing in mind they still have debt. I mean, they've done a great job, but they've still got 1.1 mil in debt and 2 years left to work. So they're not looking at extinguishing the debt in the next 2 years because they haven't talked about triggering a sale.
Yeah, exactly. So so this is all part of the conversation for them. And, this also then feeds into that new versus established conversation. Each option comes with its own trade-offs around capital growth prospects, depreciation and build quality. So it's not a straightforward swap. And we certainly, as you just touched on, have our concerns about a lot of new, particularly at the apartments, medium to high density apartments. But the conversation's worth putting on the table. But either way, they need to run the numbers properly because the outcome could look very different depending on which path they take.
Yeah, very much so.
Cate, do you think these tax changes could actually reshape demand in Melbourne's established apartment market if investors start chasing lower priced dwellings because they simply can't afford the cash flow hit on houses? Could that be the catalyst for a stronger growth cycle for the quality units and apartments, or are there still too many headwinds to overcome? We've sort of spoken about that a bit before.
I've kind of got two answers on this one. I think yes. But I'm fearful that it could be a stronger reaction to these changes than what it actually deserves. And the reason I say that is we've got a lot of buyers agents, mass style buyers agents that are pretty excited about the idea of having a client buy, 10 properties instead of 5. And that's sort of what we're talking about. When you're going for the lower priced, higher yield properties, you can't expect that a sugar hit from a policy change will deliver you strong long-term growth. It might be an immediate jolt. And again, it depends on what happens with the whether the policy is revoked. If it's repealed, then I think that it might be, not a flash in the pan, but not as lasting as some are expecting. People need to be really careful about the idea of having lots and lots of lower priced properties, and I'll share why. Your maintenance costs on the big ticket items still, pop up. You can't avoid having to put in a new kitchen or a new bathroom or resheet the roof or whatever. There'll be, whether it's hot water service, these things come up and they have to be provisioned for. You're lucky if you get 25 years out of a kitchen and a bathroom in a rental property because tenants are hard on them. So if you've got 5 properties,
a long time.
It is. I usually find it's 15. In ours, it's 15 years.
Yeah, I would have said
and
15.
You don't want it to be so horrible that. Exactly. 10. Well, 15 we've managed to squeeze out, but by the time you get there, it's looking pretty rugged and it really needs to be fixed. So if you've got 5 properties that you need to do bathroom and kitchen renovations on every 15 years, that's expensive. But if you've got 10, you've really got to ask yourself if your positive gains are worth the effort, because they can be whittled away when you're starting to get these big ticket items. So it can look really good for the first 10 years as an investor when you're getting cash flow positive. But when it comes time for a kitchen and bathroom revamp or roof resheeting or whatever it is, it can be really costly, and you can start scratching your head saying, well, I haven't had a lot of capital growth. I've had some really good yield, but it's just come into my account and then gone straight out again. So I think that's the real question we have to ask ourselves when we're looking at lower priced acquisitions and more of them, because you still can't get away from those maintenance costs.
Yeah, and it's why people shouldn't be flippant about holding costs. Often people sort of want to ignore the holding costs at the start of making an investment decision, or even when they're factoring in how it impacts their overall cash flow. potentially because, major capital improvements, redoing a kitchen or a bathroom, those types of jobs are only every 10 or 15 or whatever years. And this conversation goes to the home as well as the investment property. And, particularly if you're talking with people who've only owned property for 5 years or 8 years or 10 years, and they might own a couple properties, they might own three, and they've never had to go through that phase of having to actually fork out that cash. So they find it hard to fathom and actually factor it in because they haven't been hit with the reality of going through that process as yet.
Yeah, very much so. I completely agree. I want to chat about where interest rates are at. And, obviously the LVR that they're talking about is 105% for this one. They want to borrow the whole amount. So have they actually stress tested the cash flow impact given where rates are sitting? How do you think the equation will shape up, Dave?
Look, I think it'll be negatively geared on this property.
Let's say they can
Particularly,
get $500 a week rent and their strata fees are $2,000 a year because the block is in reasonably good shape.
yeah, yeah. So what's the question?
Well, do you think, obviously it will be cash flow negative, but
Yeah.
they've got to take into account where rates are sitting and also where rates
Mm.
could go?
Yeah, look, I mean, I think this could turn positively geared in a short period of time.
Yeah,
Yeah. So, look, I
all
think
things going well.
all things going well, I think it's what's really clear is rents are going to continue to rise. You know,
Yes.
what's going to happen with capital growth is more fuzzy, if you like. But I suspect, the money markets are expecting the first rate reduction. And look, interest rates are very fickle and hard to predict because major, international events can change what's happening with economies, what's happening with interest rates. But let's
Mm,
say we have our next rate reduction in the second back half of next year. That's certainly going to be a green light for a lot of people. And for those who follow markets more closely than others, the early movers, they're going to be making their moves. Some will be making their moves now, like these guys and others, clients we have, you have, who are
yep.
going, look, we know the market is a good buying opportunity right now. We know rents are going to go up. We know at some point in time, in the future, prices are going to go up. We're going to start buying now. So some people are doing that right now. So back to the question, I think they can be very confident their yields are going to, their rental return will continue to rise. And relative to the entry price point, they might enter at a price, yield of 5.1 or 5.5. But I
Yes.
suspect in a couple of years, relative to the purchase price, that yield will be up at like around 7%. So they could be getting neutrally or positively geared. And I think that's the big opportunity for
Yeah.
investors over this next. You could turn a property into be positively geared within 2 to 3 years, whereas previously, you've been looking at 7 years, 10 years, or longer. Obviously, it depends on whether it's the asset class where you buy.
Yes.
But these apartments have pretty high yields.
Yeah, agreed. And look, I'd call it an educated speculation.
Yeah, yeah,
And it's
yeah. I agree.
interesting. We're not
Mm,
the first capital city in recent times to hit 5% for units. We've seen
no.
it certainly in WA and Northern Territory,
Yeah,
and a lot of
yeah.
investors were buying there
Six and
during the
sevens.
boom.
Yeah.
Absolutely,
Mm,
getting cash flow positive from the start, which is quite amazing.
yeah.
So, Dave, given that they want to borrow the full purchase price plus the costs, how do you think that'll play out for them?
Yeah, look, it's a really good question, Kate. I think like we've already touched on the cash flow challenge of a fully borrowed purchase without negative gearing. But for them, there's another layer to this that I don't think that Scott may not have fully accounted for yet. So Scott estimates their super balance will be down to 100,000 in 6 years. But has that factored in the cash flow cost of this property? So realistically, this purchase could cost 100,000 or more over that period when you add up interest, holding costs, and any vacancy. Now, it may not, but that is a risk he should consider.
Yep.
Has he factored in the super could fall faster than is expected currently? That would be a question I have for him. Has he factored in that potential downside when he says what his super will be at in 6 years' time? And, that whole plan does depend on Melbourne growing enough that you don't need to sell assets too early or too cheaply. So I just say, look, that's just something for him to understand, which we've already mentioned, what happens if the performance disappoints over this period of time, and he should be mapping out those scenarios as well.
Yeah. Yeah. Agreed.
So, Kate, for the past 20 years, we've seen houses leave units in the dust in terms of capital growth. But if we look back 30 or 40 years, the story was very different, as we've sort of touched on a little bit. Is there a case of history repeating itself, do you think? Or has
Yeah.
Melbourne fundamentally changed in a way that means apartments always sit in the house's shadow?
No, I don't think just because we've seen a long period of houses outperforming units doesn't mean that that's the new cycle. Lots of things in the property market are cyclical, and I would argue that that is one of them. And I've done a little bit of background scouting here. In the late 1980s to early 1990s, Melbourne and Sydney units experienced stronger growth, and the idea behind that was affordability constraints pushed buyers towards apartments.
Yeah.
So not across the board, but in a lot of suburbs, unit price
Mm.
growth exceeded house growth.
Yeah.
Sydney has had a longer and stronger run than Melbourne on that front.
Mm.
And then around 2008 to 2010, again, government intervention. Following the GFC, we had first home buyer boosts and grants and all kinds of goodies on offer, including
Yeah.
very low interest rates at the time. And many entry level unit markets outperformed again then. And only recently, from 2023 to 2025, across several capital cities, again, units outperformed houses. And that was, put down to a widening affordability gap. But we did see Melbourne units outperform in that short space of time as well. So I don't think that we can just hang our hat on houses always outperforming. I think everyone's got used to that because we've enjoyed that for, 20 plus years.
Mm.
I think that changes like we're experiencing and influences like growing rental yields and people moving into the city. We've also got to consider new arrivals. We've got a population growth story in Melbourne like no other city, and a lot of our skilled migrants have come from high density apartment lifestyle cities. And so
Yeah.
I think we can anticipate, for a lot of different reasons, that we will have periods where units outperform houses.
Yeah, yeah, I think that definitely all makes sense. So, if an investor has a budget of around 500,000 today, would you rather see them buying a well-located apartment in an established middle ring suburb or a unit in an outer ring location? What investment grade characteristics would help one outperform the other over the long term, do you think?
Yeah, it's a very general question, but I want to
Mm.
answer it. Obviously,
Yeah.
there are nuances depending on what you're comparing it to. I can't help but think, the outer ring, outer fringe area and the activity centres and the CBD and, the new stock will see a lot of investment activity. But also, we know that often new builds, especially higher density new builds, happen before infrastructure and amenity is complete. And that can be a real frustration. And people don't generally choose to live in the fringe. They usually, it's not an aspirational move, it's an affordability move. So I always say that, money grows where money goes. If you're targeting an area where household incomes are rising, you're generally looking at areas where, people have good, strong employment, strong salaries. They want to live in the cool spots. They want to be in the nice suburbs. And that's where I would chase an investment location for a long-term purchase decision. So for me, I'd rather an apartment in the inner or middle ring than a larger unit in the fringe.
Yeah. And ideally, you're finding an apartment with two bedrooms, particularly with the working from home phenomenon. And ideally, if it has a bit more space, an ability, even if you're not If you're going to have someone sleeping in both those bedrooms, you've got a space to be able to work from home. That certainly makes apartments or units more enticing as well. And one thing with those older established units, historically, they've tended to be a bit larger.
That's right. And you've mentioned 2-bedroom, and for good reason. The first and foremost reason for me is that I don't like to buy anything that the banks don't like. So if it's under 50 square metres of internal floor area, so we can't count eaves or balconies or car spaces or anything like that. If it's under 50 square metres, you've already got a challenge with your lenders. You might find a lender that says yes, but you're starting to get into that grey zone where it starts to introduce risk.
Yeah,
the other reason
particularly the new apartments, which tend to be smaller. Again, yeah.
And the reason I also like too is you can rent out a room. And you've got more flexibility. What if you have a child or you meet someone or you have to work from home? You've got more flexibility when you've got a 2-bed.
Yeah, that's 100%. That's certainly how I started. 2-bedroom unit in Kew East. Rent out the second room to a mate. Helps with the mortgage.
Totally.
Now, one thing that worries a lot of investors is strata. It's not just the quarterly fees, it's the special levies that might arise, aging buildings and ongoing maintenance costs or issue with the new build that can come out of nowhere. With negative gearing benefits now reduced, certainly for established, how much more important is it to scrutinise owners' corporation costs when assessing whether an apartment stacks up as an investment?
Oh, it's absolutely critical, Dave. Absolutely critical. One of the first things I look at when someone sends me an address, I'll check it on the system, make sure it's in the right zone. I'll do a street view, make sure it's not an ugly spot. I'll then look through the photos. You can see the order of things here. I don't even want to look at photos if it's in a commercial zone. But once I've decided that the apartment broadly looks good in the ad, I want to see the contract of sale. I need to understand that it's the right title type. We've spoken about stratum and company share. I want to understand if it's a problematic title type, and then I'm looking through the owner's corporation minutes. And all of this is before I get in my car and drive to it. Because if they've got special levies or expensive issues that have been reported, I want to run a mile. And particularly if there might be nothing wrong with the block, but its owner's corporation fees are $5,000, $6,000, $7,000, $8,000 a year. I've seen $25,000 a year. People need to know exactly how much this thing will cost them in strata fees and ongoing maintenance or special levies before they start banking the positive returns.
Yeah, look, I think there's some great advice for our listeners here, particularly if they're looking to buy an apartment. So let's just double click on this a little bit and go, look, step one, you made the point, you're not even going to consider, you don't even really want to look at the photos. If you know the address, there's this apartment for sale, you want to have a look at, is it in and around commercial or industrial buildings? How is it located? Is it in the wrong zoning? But even is it just in a really bad position that it doesn't matter how beautiful the block or the unit is itself, the location is a write-off.
Yeah.
That's your first point. And then the second point is, again, I'm not looking at the apartment. Let's say it ticks that box. Now you're looking at the costs, any issues to do with strata, maintenance, etc. So I think they're really powerful points because, the sexy stuff is the bedrooms and the floor plan and the natural light and the apartment, but you're working through two elements that might be a big cross before you even get to that the sexy part of what the actual apartment looks like.
Absolutely, because if it's hard to finance or if the cash flows are awful, the person won't be able to hold it. They might not even be able to settle it. So apartments are interesting. I've had, since, the budget announcement and all of these people flocking to the idea of an apartment, I've had a lot of investor inquiry about apartments. And they look at my fees and they scrutinise them and say, oh, well, I'm only spending $600. Can you reduce your fee? And I have to say to them, this is so much more work than a house. I would much rather you were spending $3 million. I'll charge you the same amount. That's how hard apartments are. And the scrutiny and the work, the due diligence, it's really important. And I love it all, but it's a lot longer and a lot tougher.
Yeah, yeah, that's a really good point as well. There's more things that can go wrong when buying an apartment. Not just,
Most definitely.
like in terms of the asset you select, and obviously the things that can go wrong is once you actually own that asset and you want to
Yeah,
go in with your eyes open.
absolutely. Now, we're coming towards the end of our episode, but there's one more element that I want to touch on. I'd like to flag up front that this is veering into financial advice territory, so listeners should absolutely speak to a qualified financial advisor about their own situation. But Scott has mentioned their super balance is likely to be down to $100,000 in about 6 years. Is drawing down super the right move, and what should they be aware of?
Yeah, look, I just wanted to touch on this, Kate, before we wrap up, because this might be the canary in the coal mine, shall we say, for Scott. It might be, again, something that he isn't factoring in. And I've seen often people who have been really focused across their lifetime to build wealth through investment properties often have neglected understanding superannuation and the transition to retirement phase. And obviously, saw that a fair bit owning a financial planning business for over a decade. So, look, once you hit 60 and move into pension phase, earnings inside super are tax free. So that's very valuable. That's a genuinely powerful position to be in, and it's easy to underestimate how much that's worth over time. So, drawing down super early to fund a property purchase or to help cover cash flow shortfalls while waiting for Melbourne prices to recover, that means potentially giving up tax free earnings at exactly the point in life when the tax advantage is most valuable. The specifics of their super and property investment situation really should be worked through with a qualified financial advisor or research for themselves if they're very diligent and willing to commit the time. But it's absolutely a conversation worth having before they make this decision as well. It may pay to have a strategy so that they can continue to transfer wealth into this super environment. And this may even include via the sell down of an investment property or properties and getting that more cash and investment into this superior tax environment of super. But look, I'm definitely not providing financial advice. I just think, it's definitely something they should be considering.
Yeah, it's a great word of warning. I think as soon as we're talking about super, that it's a licensed financial product, as you just said, and you need to be talking to the right person, a trusted advisor who's qualified. I have
Exactly.
loved this ep. We've tackled so many angles. And Scott, I hope that this has been helpful. And we didn't want to make too many assumptions because you guys have done so well. And I'm sure that there's a reason for your motivation with Melbourne. So I hope we've uncovered a little bit there. And I know that we can talk about apartments in future eps as well, because it's certainly becoming the flavour of the day. But I'm going to move into gold nuggets. Dave, have you got one?
Now it's time for us to go mining for our gold nugget property tip of the day.
I do. Look, I can't stress enough the importance of modelling here. And this applies to everyone, not just Scott, his wife, who sent in this question. Before you commit to any property decision, to model out what your cash flow actually looks like after you settle, and also how this property fits into achieving your long-term goals for retirement. So, look, we have software that can drill down into this on your next purchase as part of our free strategic mortgage broking service. So you can sit down with the real numbers rather than working off a gut feel or the back of an envelope or manual calculations or Excel spreadsheets that factor in most things, but not every aspect of your financial position. So then you can you can ask yourself the bigger question underneath all of it: does this purchase genuinely improve your position, or does it just add another moving part to a portfolio that's already doing its job well? You also have to think about where you are in life. Obviously, if you're in your 20s or 30s, in this circumstance, you'd say yes, absolutely, go for it, subject to the numbers making sense. Because if it doesn't work out, you've got decades to recover. It's well accepted that younger people can afford to sit in a higher growth, higher risk investment option, because they've got time to ride out the bad years if and when they occur. But Scott and his wife are much closer to retirement. And so this is the time to factor in a more balanced or conservative option, because they simply have less time to recover if this doesn't work out. So, risk and time frame, they're joined at the hip. The closer you are to retirement, the less runway you have if the decision doesn't pay off. So sometimes the best property decision is the one you don't make. If they'd like to map out their goal for their next purchase as part of their mortgage service, we can obviously help them with that. Also, if they wanted to work backwards to figure out what's required to get there and model the scenarios through to retirement and beyond, that's something we can assist with as well. But, they also have, the superannuation piece of the puzzle to factor in. So either way, they really just should. This is important to get right given their stage of life.
I've got a very, very short gold nugget. And Dave, I want to pinch this little saying from you because I love it. Pollyanna versus henny penny. I think when you're looking speculatively at something, and like I said, it can be an educated speculation, but at the end of the day, none of us can predict the future. Just some of us can generally get it right more so than others. And that comes down to experience and education in that field. I think for anyone looking at our current markets, knowing just how dramatic the shift in sentiment has been since the budget announcement and what could happen if things are repealed or changed, we have to focus on the Pollyanna version and the henny penny version and everything that sits in between, so that we're not setting ourselves up on a short time frame for disappointment if the Melbourne property market lags for a bit longer.
Yeah, well said, Kate. I think we've covered a lot here for Scott.
Heaps.
And his wife and a lot of different, I guess, core strategies and considerations for anyone who's looking to build out their long-term property strategy and plan.
Look at us go, just the two of us, and we've chatted for 50 minutes. It's been a great chat, and I dare you and Anne-Marie to come up with a title that fits everything we've covered, but I really hope our listeners have enjoyed it.
We'll see what we can do. I hope they have too. And look forward to seeing Mike next week.
Likewise.
And you from Bali.
Yeah, I'll have some palm trees and, pina coladas in the background.
Magnificent.
See you next week.
See ya.